welcome back to the deep dive. Something I find really fascinating is this intersection. How the super modern world of stock investing gets shaped by religious principles from centuries ago.
It really does. It almost sounds like a contradiction, doesn't it? But it's actually a very deep link.
How deep are we talking?
Oh, it goes right to the core of Islamic finance. And that's exactly what we're diving into today, how stocks get screened very carefully for Shariah compliance.
Okay.
It's more than just rules, though. It's this whole journey, really, from ancient partnership ideas right into today's complex capital markets.
And for this journey, we're looking at a specific academic source, right?
Yes, exactly. Our main guide is a research article called A Study on the Differentiation of Shariah Screening Criteria for Stocks. It's by Batuhan Buğra AKARTEPE, and it was published in the academic platform Journal of Islamic Research, APJIR, back in 2022.
Got it. So what's our mission for this deep dive? What should you, our listener, expect to understand by the end?
Well, our goal is to really unpack that whole story. How Islamic finance even got involved with capital markets, this key two-step screening process for stocks.
And critically, why there isn't just one set of rules.
Precisely. Why the differences. You'll get the core methods behind these decisions and, what it actually means when you're looking at investing in Shariah-compliant assets.
Okay, let's start at the beginning then. Back to basics. How did Islamic law originally look at financial deals? And how do stocks fit in?
So the foundation really is partnership. That's a fundamental type of contract in Islamic law.
Right.
And stocks in Islamic finance are seen as, maybe the most important financial tool based on that partnership idea, because investors become part owners, you see. Yeah. They share in the profits, but also the losses.
That makes sense conceptually. Partnership equals shared ownership, shared risk. But if it fits so well, why was there pushback initially? Like a reluctance to actually invest in stocks? Yeah. What was the hang-up?
Yes, that's where it gets really interesting, because even with that basic link, it wasn't always a green light. Early on in modern Islamic finance history, people had real concerns.
Like what?
Well, some stock market stuff looked a bit too much like gambling to some scholars. Then there was the feeling that with these big corporations, there wasn't enough direct Shariah oversight.
Okay.
And a big one, limited liability. The idea that you, as an investor, are only responsible for the money you put in, not all the company's debts.
Yeah.
That didn't quite mesh with the traditional Islamic partnership structures, where risk and reward were often, more directly tied together.
So that was a genuine sticking point for a while. How did they get past that? Was there a specific turning point?
Absolutely. In 1992, that was the year. The International Islamic Fiqh Academy made a really crucial decision.
What did they decide?
They basically said, look, not all stock market activity is forbidden. And importantly, joint stock companies can actually align with Islamic partnership law. That decision essentially resolved the whole limited liability issue, smoothing the path for much wider stock investment within Islamic guidelines.
Right. So 1992 happens. The main objection is addressed. Does that mean everything is suddenly okay to invest in?
Not exactly. It wasn't quite a free-for-all. Even after 92, you still couldn't invest in companies whose main business was clearly forbidden, things like alcohol, gambling, pork. That was still a definite no.
Okay, the obvious ones.
Right. And companies that were 100% pure, totally compliant in everything they did, well, you could invest in those, but honestly, finding them in the modern global economy was, and still is, incredibly difficult. Very rare.
So before this mixed company idea came along, it sounds like if you wanted to follow Shariah principles, your investment choices were, pretty limited.
Extremely limited. You said it's slim pickings. It just wasn't practical for building a diversified portfolio or really participating in the market fully.
Which must have been a barrier.
A huge barrier. So the solution that emerged, the practical way forward, was allowing investment in what they called mixed companies.
Mixed companies, meaning?
Companies whose main business is perfectly fine, legitimate, but they might have some minor income or transactions that aren't Shariah compliant. Like maybe they earn a small amount of interest on their cash reserve.
Okay. But there had to be a limit, right?
Exactly. That was the crucial condition. The non-compliant part had to be limited. It couldn't be substantial.
And I guess figuring out how limited is limited enough.
Yeah.
That's where the screening comes in.
You got it. That's precisely why Shariah screening activities were developed. To identify this non-compliant stuff, measure it, and set clear thresholds, basically. Cut-off points for what's considered acceptable.
Okay, threshold. Let's unpack that screening process then. You mentioned 2 stages.
Yes, generally it's a 2-stage process. First up is sectoral screening.
Sectoral. So based on the industry.
Right. They look at what the company actually does.
Yeah.
And some industries are just universally out, according to all Shariah boards. Alcohol, gambling, pork products, straightforward non-starters.
Yeah. Okay, those make sense. The definite no-go areas. But are there industries that are more debatable, gray area?
Oh, definitely. Some sectors spark debate. Things like stem cell research, maybe certain types of advertising or media, the defense industry, even aviation. Their compliance isn't always clear-cut, and different boards might have different views.
So it's not always black and white.
Not at all. And that's why just banning a whole sector isn't always the most accurate way. It's better to look at the specific company. You know, like you mentioned, not every airline serves alcohol, so banning all airlines might be too broad.
Right. Nuance matters. Okay, so a company gets to the sector check. What happens next?
If they pass the sectoral screening, they move to stage 2, financial screening.
Financial. Okay, so now we're looking at the money side.
Exactly. This is where they dig into the company's books. They scrutinize its financial health, specifically looking at its debts, its liquid assets like cash, and any income it gets from non-compliant sources.
And thresholds come in here again, right?
Yeah.
If the numbers are below certain levels.
Then it's generally deemed Shariah compliant for investment purposes.
Correct.
What specific financial bits are they zooming in on?
3 main things. First, debt. But critically, only interest-bearing debt.
Why only interest-bearing?
Because interest, or riba, is fundamentally prohibited. Now, there's an understanding that in today's world, purely Islamic financing isn't always available, so companies often end up taking on some interest-bearing debt.
So it's a concession.
Yes, a sort of concession to necessity. A small amount is tolerated, not because interest itself is suddenly okay, but because completely avoiding it can be practically impossible for many businesses.
Interesting. A pragmatic approach. What's the second financial check?
Second is liquidity. This looks at the company's mix of cash and debt. It connects to an Islamic legal rule called sarf, which deals with exchanging monetary values.
Sarf! Okay, what's the principle there? Basically, if you exchange money for money, like currency, it has to be equal amounts and done immediately, on the spot. No delays, no unequal values. It's about fairness. And trading debt itself is often restricted. So they look at the company's cash and debt structure through that lens.
Got it. Equal exchange, spot transactions for money-like things, and the third element.
The third is illegitimate income. This is any income the company gets from interest or other non-Shariah compliant activities that slip through.
And what happens with that income?
It has to be purified. That means the investor needs to calculate their share of that illegitimate income and donate it to charity, essentially removing its taint from their investment returns.
Purification.
Yeah.
Okay. Does everyone agree on how and when to do that?
No. There are different views on the specifics, like when exactly you calculate it, who's responsible for donating it, but the underlying principle of removing that prohibited income is consistent.
Okay, so we have the 2 stages, sector and financial. And the financial stage looks at debt, liquidity, and illegitimate income using thresholds. But you mentioned earlier that different groups have different thresholds. Why? If they're looking at the same things, why the different numbers?
Right. And that's really the crux of it, the most fascinating part highlighted in the research. While many Shariah advisory boards use similar criteria, debt, income, etc., the reason the actual thresholds differ, well, it mainly comes down to their underlying methodology.
Methodology, meaning how they arrive at the rules.
Exactly. How they derive those specific percentage limits. Everyone agrees the non-compliant part should not be much, right? But how much is much? That definition varies based on the interpretive approach they take. The source identifies 3 main distinct methods.
3 methods. Okay, I'm ready. Let's hear them. What's the first one?
The first one is what the paper calls the religious texts-based approach. You might also hear it called Nas-based. Nas refers directly to the primary texts, the Quran and the Sunnah, the Prophet Muhammad's traditions.
So they look for direct instructions in the scriptures.
Pretty much. They try to determine the principles and the thresholds directly from what the texts say. They're looking for explicit guidance on what counts as much or excessive in those sources.
Can you give an example of a threshold that comes from this text-based method?
Yeah, a really common one you see with councils using this approach, like the Malaysian Sharia Advisory Council, AAOIFI, Dow Jones, S&P, even the Turkish Participation Banks Association, is a threshold around 30 to 33%.
33%. Where does that number come from in the text?
It's linked, perhaps surprisingly, to a specific hadith, a saying or action of the Prophet. It involves a companion named Sa'd bin Abi Waqqas. He was ill and wanted to donate a large portion of his wealth, like 2/3.
Okay.
And Prophet Muhammad advised him against it, saying essentially, no, donate 1/3, and 1/3 is already much. So that figure, 1/3, or about 33%, gets adopted as a general upper limit for non-compliant elements in a company.
Wow, okay. So taking a specific ruling about charity or inheritance and applying it quite broadly to corporate finance, that's quite a leap, isn't it? Is there debate about that?
Oh, absolutely. Academically, the direct applicability is debated. But its practical adoption by major standard setters shows it's become a widely accepted benchmark in the field, interpreted as a general textual guideline for defining excessive.
Interesting. And when they do calculations using this NAS-based approach, what numbers do they use? Market value of the company.
Generally, no. This approach often favors using the company's total assets as lifted on its balance sheet, rather than its fluctuating market capitalization.
Why the balance sheet?
The reasoning offered is actually quite profound. It's drawn by analogy to the Day of Judgment, where individuals are judged based on their book of deeds, their actual recorded actions and assets, not just how others perceive them or their market value. So the balance sheet represents the tangible reality of the company.
That's a powerful image. Okay, so that's the text-based or NAS-based approach. What's the second methodology?
The second is the Fiqh-based approach. Now, Fiqh refers to Islamic jurisprudence, the broader understanding and application of Shariah principles derived through scholarly reasoning.
So less about direct quotes and more about underlying principles.
Exactly. Instead of pointing to a specific verse or hadith for a number, this approach relies on wider legal principles. And a key one here is necessity or darura.
Necessity. How does that apply?
Well, think about it. A super strict literal reading of some texts might prohibit investing in any company with any non-compliant element, which, as we said, makes investing in today's world almost impossible.
Right, because purely compliant companies are so rare.
Precisely. So Fiqh principles like necessity allow for a certain limited degree of non-compliance. It's seen as necessary to enable Muslims to participate in the economy and investment markets practically.
It's about finding a workable balance. Do we have an example of a group using this Fiqh method?
Yes, the article mentions TASIS as an example. They really emphasize looking at actual market conditions to objectively determine what level of non-compliance might be considered necessary or unavoidable in a given context.
So they use market data.
Right. They might look at things like 4-year averages for debt levels or interest income in a particular market to set their thresholds. The idea is to avoid purely subjective judgments and base the thresholds on objective reality while still encouraging improvement.
Can you give specific examples of TASIS's thresholds based on this?
Sure. For interest-bearing debt, TASIS apparently set a 25% threshold against total assets. Now, the paper notes that market averages might have been higher, like maybe 29.4% in India during a certain period.
So why 25% if the average was higher?
They chose a lower, stricter threshold. The reasoning seems to be to push companies towards better compliance, to encourage a larger pool of Shariah-compliant options over time, rather than just accepting the status quo average.
Okay, that makes sense. What about illegitimate income?
For illegitimate income, they went with a 3% threshold. Here, the average interest income might have been lower, perhaps around 1.79%. But setting the threshold at 3% allowed more companies to pass the screen.
So a bit more lenient there.
It seems so. It's a balancing act, making the screening accessible enough for a good number of companies to pass, while still maintaining the core principles. The article notes this pragmatic approach resulted in about 83% of companies passing their financial screen after getting through the sector screen.
Interesting how they adjust based on the specific metric. Okay, that's Fiqh-based. What's the third and final method?
The last one is the mixed approach. And as the name suggests, it kind of cleverly combines elements from both the NAS-based textual and Fiqh-based jurisprudential principles methods.
A hybrid model.
Exactly. The article uses YASAR as an example here.
And how does YASAR mix these approaches? What thresholds do they use?
Well, for debt analysis, YASAR uses that 33% threshold. That comes directly from the a third as much hadith we talked about earlier.
Okay, so that part is NAS-based, text-based.
Correct. But then for the ratio of liquid assets, cash, and receivables to total assets, they use a 50% threshold.
50%. Where does that number come from? Not the hadith, presumably.
No, this one comes from a fiqh rule, a jurisprudential principle. The majority takes the place of the whole.
The majority takes the place of the whole. How does that apply to company shares? Why 50%?
It's quite technical, but it relates back to that SARF rule about exchanging monetary assets. If the majority, more than 50% of a company's assets are liquid, essentially cash or near cash items like debt receivables, then the shares of that company start to be treated like cash for trading purposes.
And what does that mean practically?
It means those shares should ideally be traded at par value, face value, and on the spot, like a currency exchange. It restricts trading them at different prices or on deferred terms, which is common in stock markets. So keeping liquid assets below 50% avoids triggering this stricter trading rule.
Wow. So the methodology, whether it's text-based, principle-based, or a mix, directly impacts these crucial percentage points.
Absolutely. And these aren't just academic numbers. They have very real consequences.
How so?
They directly determine which specific companies get the green light, which ones are considered Shariah compliant, and ultimately, which stocks end up in Islamic investment funds or indices that many people invest in.
So understanding these different methods helps you, the listener, make sense of why one Islamic fund might hold a certain stock while another one doesn't.
Exactly. It helps you navigate the landscape and appreciate the complex reasoning that goes into building these Shariah-compliant portfolios. It's not arbitrary. There's a specific logic, even if different groups arrive at slightly different conclusions.
Okay, so let's just quickly recap what we've covered in this deep dive. We started with that initial reluctance towards stocks in Islamic finance.
Right, due to concerns about gambling, control, and especially limited liability.
Then the pivotal 1992 decision that opened the door, recognizing joint stock companies could fit.
But that led to the challenge of mixed companies, mostly okay, but with minor non-compliant bits.
Which necessitated the development of Shariah screening, first by sector, then financially.
Focusing on interest-bearing debt, liquidity based on SARF, and purifying illegitimate income.
And the key insight today is that the differences in screening results often boil down to the methodology used to set the thresholds.
Whether it's directly from texts like the 1/3 as much hadith in the Nas-based approach.
Or based on broader principles like necessity and market conditions in the Fiqh-based approach.
Or a combination of both, like using the hadith for debt, but a fiqh rule, like majority rules for liquidity in the mixed approach.
It really highlights this ongoing dynamic, doesn't it? This effort to apply ancient principles faithfully, but also practically in today's financial world.
It really does. And it leaves us with something interesting for you to think about. This whole discussion around screening criteria, it really lays bare a fundamental tension, maybe even a creative tension. How do you stay true to deeply held, centuries-old principles while engaging with the complex realities and, frankly, the necessities of modern global finance? It's a constant balancing act.
So the question for you, our listener, to ponder is, as finance keeps evolving, how will these different ways of thinking, these varying methodologies continue to shape not just Islamic finance, but maybe the broader conversation around ethical and faith-based investing worldwide? Could these approaches influence how we all think about responsible investment in the future?
Something to consider. It's a fascinating space where faith, ethics, and modern markets intersect.